Hi, everybody.
Hello. We'll give it a minute to let everyone join in. And I guess while we're waiting, I can do a quick introduction of myself. So my name is Shaina Watt, and I'm an assurance and accounting partner here at Hendry Warren. We wanted to do a quick reminder that we're using the Q&A feature through Zoom. So if you have questions, we will wait to the end to answer those, but there's a button at the bottom of your screen which would allow you to post any questions that you have, and we can answer those at the end. So like I said, I'm Shaina, and this is my colleague Jennifer. She's a tax partner here at Hendry Warren, so she's gonna kick it off for us.
Excellent. So you're probably wondering how we chose in the month of April, our absolute business for personal taxes, a topic to talk to everyone about today. And I was actually preparing some income tax returns for some family members, and I said, hey, I just want to confirm that you don't have any non-registered investments. And these two highly educated people looked at me and said, what is a non-registered investment? And I remembered that we often take for granted the things that we know by virtue of what we do versus the things that maybe other people have an opportunity to learn a little bit more about and how it can benefit them. So for today, we want to talk about registered investments, the deferral opportunities, the potential tax savings, and some of the compliance or pitfalls that you want to be aware of. So what we're going to talk about first is defining what a registered investment is. We're going to talk about the RRSP, probably the most common of all of the registered investments that we see on an annual basis. And then we're going to get into some of the other features, like the new first home savings account. So that was new in 2023. We'll walk through that. TFSA always catches the attention, tax-free savings account. And then we'll get into some of those compliance matters. We're going to be using menti.com today. This allows us to ask interactive questions and have the group answer them, and then it will prompt some discussion on some of the questions as we go through. You can do that by going to the www.menti.com and entering the code, or you can use the QR code that you see on the right side of the screen. We'll give everyone a couple of minutes to get online there.
Perfect. And the code will be at the top of the presentation throughout. So if you miss it on this slide, it'll be up there.
So the first question that we have here is, do you have a registered investment account? And we said we were going to define registered investments. Those are specific plans that finance has allowed taxpayers to invest inside that have certain benefits over a non-registered account. So we've got some answers coming in here. Surprisingly, the FHSA is doing quite well, which is great to see because you'll see that there are some really great benefits to using that.
Great.
Okay, so what is the most important factor to consider when deciding which investment vehicle to use? What's the first thing on the top of mind? Is it income taxes? Is it market conditions, investment and cash flow objectives, or the winner of the Super Bowl?
Jennifer, do you love that someone said income taxes?
I do, and that's where my heart would be. Unfortunately, it may come as a surprise that me as a tax partner would actually say it's your investment and cash flow objectives. Although income taxes are a main driver in considering that, and the income taxes are often the output of the different vehicles that you're going to use, it's actually investment and cash flow objectives, both short-term and long-term, that actually are going to help you decide how to optimize the investment inside of these different vehicles to have the effect of optimizing your income tax result. But the determination of which one to use is actually going to be driven very much by the investor and what their primary goals are. So we're going to be using these terms consistently through the presentation. So we wanted to set the baseline for what they mean, because again, not taking for granted that there is a difference and the distinction is important. So tax deferral talks about taking taxes and kicking them down the road to a future year. So avoiding the tax in the current year and recognizing income, usually that's going to be taxable in a future year. So deferral, putting off tax until the future. Tax savings is where you ultimately avoid paying tax, either by the way you're investing in these certain accounts we'll talk about, or by shifting income to a different year where you can take advantage of lower graduated tax rates as a personal individual taxpayer and avoiding tax that you might have otherwise suffered at a higher tax rate depending on your income year over year.
Great. Thanks, Jennifer. So whether it's a deferral or savings, I'm interested. So how do we actually achieve it? I want to break down the RRSP just a little bit for us. So what is an RRSP? Simply put, it's a registered investment account that's available to you in Canada. And from the outside, it looks just like any other account. It can hold cash, bonds, stocks, and you can transfer funds into your RRSP and purchase investments just like you would with your other investment accounts. What's different is that when you contribute to your RRSP, you get a tax deduction as well. The funds can grow inside the account tax deferred. So regular investment accounts earn income in the form of dividends, interest, etc., and you have to pay personal tax on those each year. So how you can achieve tax savings is to plan the timing of your contributions when your income is high and your withdrawals when your income is low. So why does that matter? The withdrawals from the account are taxable to you at the time they're taken out. So if your income is lower in that year, then the tax bill you'll also get is going to be lower as well. So that's where we see an overall savings that Jennifer was mentioning. And we'll go through an example of that in a little bit. So I want to go through a little bit of the technical pieces, some smaller details, but very important. So at 71, your RRSP will be converted to a RIF and you'll be subject to minimum annual withdrawals. So generally, if there are funds left in your RRSP at passing, those amounts do become taxable to you. So RRSPs come with an annual contribution limit, which is based on your income. So it's very important to plan the timing of your contributions with your accountant and with your financial advisor. The contribution room accumulates over time, but the exact calculation is a little bit complex. So CRA calculates your contribution room based on your earned income from the previous year, up to a specific maximum. Everyone's room is going to be different and unique to your personal situation. Additionally, if you can't contribute that full amount in any given year, the room does carry forward indefinitely. The deadline to contribute is generally 60 days into the next calendar year, and you can check your RRSP room online with CRA, or your accountant can usually find that information for you. So some other RRSP opportunities that we have are the spousal RRSP. So this is where you have a lot of RRSP room and your spouse does not. And in retirement, you may have high income and they will not. So here we can have an opportunity for further tax savings. So you can contribute to your spouse's RRSP account and use your contribution room. You get the deduction for taxes now. In retirement, your spouse will then draw those funds out of their RRSP and into their income. So it's shifting the tax into their hands in retirement when they will pay a lower marginal rate. CRA doesn't care who made the contribution, it's just who withdrew it for the taxes at the end. It's important to note that there is a 2-year waiting period before you can withdraw the funds. And when it comes time to purchase a home, the RRSP can be very powerful. So normally withdrawing from your RRSP before retirement comes with a tax, but the home buyers plan gives you a free pass of up to $35,000 to withdraw funds without facing the taxes you would otherwise have to pay. The catch is that the RRSP home buyers plan isn't a permanent solution, so you do have to pay those funds back, but you have up to 15 years to pay the funds back into the RRSP that were taken out under the home buyers plan. There is some fine print, so you do have to be a first-time home buyer or you haven't owned a principal residence in the past 4 years, and the home that you're buying has to be your primary residence. So overall, it is a really great way to take advantage of that 15-year payback plan. So Jennifer, let's say I earn a salary of $200,000, lucky me, and after my taxes are withheld, I take home cash of $133,700. I was looking at my budget and I realized I only need $100,000 to pay my mortgage and all my bills. I don't have a pension plan through my work. What could I do with the excess cash, and how could that help me in my retirement planning?
So this is a really great example. And of course, one of the things I'm going to zero on immediately is that you don't have a pension plan. So in retirement, other than CPP and OAS and other investments you may have, you likely will be making less money than you are in your working years. So your salary of 200,000. And we'll keep this in mind because that's part of this opportunity of tax savings. But in the immediate example, you've got net pay, so after taxes of about $133,700, and you need $100,000 to live. So roughly $33,000 available to invest. Now you could take this money and invest in a non-registered account being not a special account that we're talking about today, but a regular investment account. As you earn income on that investment year over year, you'll pay tax on the dividends, interest, foreign income in the year that you're earning. So it will be taxed on top of the salary that you make of 200,000 in a relatively high bracket. If instead you were to contribute this amount to your RSP, and given that you don't have a pension fund, likely no grind on your RSP room, you can contribute this amount to your RSP subject to your deduction limit. Not only do you get a deduction in the current year, which is going to reduce your taxes and based on your employment income, likely result in a refund of some of the taxes that are withheld. What you're also going to do is you're going to earn that income inside of the fund. So as you're earning the dividends, the interest, the foreign income, this passive investment income in your RSP, you're not paying tax in the year that you're earning it. It's sheltered inside of the fund. Someday in the future, when the funds are withdrawn, likely in retirement, that's when you pay tax. Now that's tax deferral, which is great. Where we get tax savings, as I mentioned, is in retirement, your overall income will likely be less than it is today, i.e. when you're no longer earning that $200,000 salary and you don't have another source of income like a pension fund, you are going to have more graduated rates available to you. So when you get the deduction in the current year of that 33,000, and someday in the future, you're going to take that out of your RSP along with the income that you've earned along the way, it'll be taxable in that year of retirement. And you're going to access lower graduated rates because in these years in retirement, you no longer have that salary. That's tax savings. It's the difference in the tax rate you would have paid on that income, on that investment income, and on that salary that you've deferred by contributing to your RSP and shifting it to the future when you have a lower graduated rate. The net difference is a tax savings to you as a taxpayer.
Okay, so this year I'm paying about 33%, and in retirement, I would pay a bit less than that for sure.
That is the theory of RRSPs and the goal of most taxpayers.
Great. Okay, makes sense. Okay, so last year we got something new in the registered account world, the first home savings account. So the first home savings account is a savings account that's meant to help Canadians save for their first home purchase. And it allows individuals to contribute money into the account where it can grow tax deferred until it's needed for the purchase of a home, a qualifying home. So to qualify, you have to meet specific criteria, which are similar to the home buyers plan. So, it has to be your first home or you haven't lived in a primary residence for 4 years, those type of criteria to meet. So like the RRSP and TFSA, there are contribution limits for the FHSA. You can contribute up to $8,000 per year with a lifetime maximum of $40,000 per individual. The amounts that you can contribute are generally tax deductible, similar to the RRSP account. However, there is no 60-day period after year end, so those payments must be made by the end of December. When you're ready to take funds out of the FHSA, there's several options to do so, all with differing consequences. So to take funds out to purchase a home, that can be done tax-free. You can also transfer funds into an RRSP account tax-free, as long as it's a direct transfer that you're making into that RRSP account. There's always the option to withdraw the funds if you need them for another purpose. However, you would have to pay tax on the year that you withdraw them for anything other than the purchase of a qualified home.
Excellent. One other thing I'll add about the FHSA is that you don't start accumulating room until you open an account, which is again a different variation of all of these accounts. So if it is something that you may be eligible for, if you think buying a home is in your future and you've never owned one before, getting an account open and contributing what you can now is beneficial. So tax-free savings account, obviously we love it. It's tax-free. And that's something that usually catches everyone's attention. Now, what people don't like so much is there's no deduction in the year that you contribute. So unlike your RRSP, where you contribute and maybe at the end of the year you get a nice refund and you feel great about it, a TFSA is not going to have that result. But what a TFSA has that is very special is when you contribute and you earn income inside of the TFSA, you'll never pay tax on that income, even when you withdraw it. So for most taxpayers, although you don't get that immediate deduction, which is really attractive, never paying tax-free is actually, very beneficial. In terms of the growth of the funds, obviously they're tax-free as long as they're inside of the account. If you make a withdrawal and start investing them in a non-registered account, obviously the character would change. The contribution for the TFSA is based on finance and CRA setting the amount. Those amounts start accruing at age 18 for all Canadian resident taxpayers, so a little bit more straightforward. Now, there's a question you might be wondering, and I'm curious what everybody's take on it is. Which is better, RRSP or TFSA? So I like TFSA. I like TFSA because we like tax-free. We like never seeing that. Now, RRSP though, depending on what your potential for earning is, could also have a lot of benefits in terms of shifting that income. I think what I would likely say is that a combination of the two is likely going to get you, in a lot of cases, the best result. Remember, each of them have their own limits that are calculated based on certain factors, and you don't have to pick one or the other. You can invest inside of both accounts. So it's going to look at the taxpayer themselves, what the future investing strategy is, what room they have available relative to the amount they have available to invest. And this is an area where, I think your advisors, your accountant, your investment advisor can add a lot of value in terms of talking to you about your goals and helping you plan for contributions to these accounts and what you might invest in each of them. So we can't get into great detail today, although we'd love to. It's a time constraint. I couldn't do this presentation without mentioning some of these other specialized accounts. So the RESP, the Registered Education Savings Plan, is one that's fairly popular in Canada. And what's great about this is we get the idea of a tax deferral, i.e. when contributions are made, there's no deduction, but that investment income again gets earned inside of this registered account and isn't taxed until withdrawal. What's also great is the withdrawal is actually completed by the individual who is earning the education, likely a child or grandchild, while earning tuition credits. So when you think about a parent paying tax on that investment income at their graduated rates, which are generally higher, versus a student who has relatively low income paying tax on that investment income, it can be very attractive. In addition to that, the RESP have government grants that go along with that. So again, income funds that are coming from the government that are trying to help taxpayers invest in education, again, for their children or grandchildren. The RDSP, the Registered Disability Savings Plan, is designed to help individuals who are eligible for the disability tax credit to invest in ways that are efficient to defer tax until the future, and can also be really beneficial in preserving their ability to claim federal or provincial disability benefits in that province without tripping up on assets tests that may limit those claims. Individual pension plans, again, very popular with business owners, entrepreneurs. They are more complicated and certainly have a decent amount of administration, but if the dollars are right, it can be hugely beneficial. So what could go wrong? Anytime an accounting or tax person tells you about really great opportunities, the first thing you may want to ask yourself is, well, what's the... In these plans, there are restrictions to what you can invest in. So if you think you might have something that's going to have a really great quick return, you should be thinking, can I invest inside of one of these registered plans? And these restrictions are well documented and something that you should talk to your financial institution about before you decide to invest inside of one of these plans. Failure to estate plan is also something to consider. So as Shaina mentioned, when you pass away, the full value of your RRSP, for example, or RIF comes into income. There are deferrals if you have a qualifying beneficiary, such as a spouse, where the plan can actually roll or transfer tax-free to that spouse, and the income tax isn't levied until the death of that second spouse. Now, it's important that both with the financial institution, you've got them listed as beneficiary, but also that it aligns with your will and other estate planning objectives. So making sure that as you update your will, as you consider who you want to benefit from your assets, that these are updated and consistent with how you've set up these accounts. And then finally, and probably most commonly, overcontributions. There are limits to the amount you can invest or contribute to these accounts. And we kind of talked about that as we discussed each of the plans. You can't do all of your investing just because you want to in any one of these accounts. There are restrictions. And what happens if you exceed these amounts that have been calculated? It's called an overcontribution. And what that means is that when you've overcontributed, you will be levied a penalty, normally 1% per month, on the amount that you've overcontributed until such time as a withdrawal has happened. This results in, again, penalties, often interest payable to the CRA, and a whole level of compliance as returns need to be filed to report these overcontributions to the CRA. So when you do go to invest in any of these accounts, as Shaina mentioned, either look at your notice of assessment, look at your CRA documentation to see what they've calculated as your limits, or speak directly to your accountant, who can usually access this information for you or help you find out what your amount is or is going to be in a particular tax year.
Perfect. So getting started and kind of what you can expect from these registered accounts, opening an account in RRSP, a TFSA, there's so many options and it can seem daunting, but speaking to your financial advisor and starting small is such a great step. So just getting the account open, and from there you can decide on regular contributions and what the investing strategy will be that you want to go with your advisor. So come tax time, which we're all hopefully familiar with right now, your RRSP will give you slips that you should send over to your accountants to ensure that the contributions you've made are utilized on your personal tax return. The TFSA slips are automatically tracked, so they are not actually reported on your tax return, and so you don't need those for your personal tax preparation. And lastly, an important part is ensuring that your RRSP contribution room is up to date. You need to make sure you're filing your personal taxes every year so that growth in your RRSP room is tracked properly. So any questions? I think we have some questions in the Q&A.
Yeah, I see a couple of questions here, so I will go in order and we'll answer as many as we can. So the first question is, I operate my own business. Which of these accounts should I prioritize? And that's a really great question. And of course, the answer is it depends. So what I'm really going to answer with is, here are some things to consider as you consider each of these accounts. So the first question is, are you self-employed and you report your business income on your personal tax return, or are you incorporated? Or could you potentially incorporate in the future? This is something that you'd want to consider when thinking about these different accounts, because we'd want to know whether your income is made up of earned income personally, which would be a sole proprietor, or potentially you take dividends from a corporation, and maybe there's a larger question at play with how to contribute. The other thing that you're going to want to think of is, does your income change significantly year over year? So are some years lower income from earnings and some years higher, or is it relatively consistent? The reason you'd want to consider that is RRSPs may be beneficial in terms of evening out your tax years or smoothing that income to make sure that you're not paying really high tax in one year when your income is high and lower in the next. The great thing about RRSPs, even though we call them retirement savings plans, is you don't have to wait until retirement to put money in and pull it out. So that can be really beneficial as a business owner, especially a sole proprietor. The other thing, and I think we talked about this a little bit at the beginning, is we want to make sure that when we think about the RSP, the FHSA, or the TFSA, that you consider what are your objectives, like separate from the tax and changing that income. What are your objectives? Are you looking at buying a home? Do you already own a home? What are your limits available in each of these accounts? So it's something that I would encourage you to speak to an advisor about, and it's going to be your own objectives really that are going to drive which is the better, or I guess, account to prioritize. But again, all of the accounts can be used, at the same time. So it doesn't have to be a pick one and stay with it. if one, circumstances change, two, objectives change, or three, you want to take advantage of the benefits of the different accounts. The other great thing about most of the accounts is the contribution room doesn't disappear. It grows year over year. So you're not missing out by, not contributing to in a current year on that room. So the TFSA room, for example, is going to grow each year if you're not using it and will be available in the future if you have excess funds available. The next question, can I withdraw the interest income from a TFSA at any point without penalty? So generally, yes. I mean, I can't give a definitive answer, obviously, without seeing it, but generally you can withdraw income from a TFSA. There's no period in which it has to be left in the account. So Shaina had mentioned, I think, specifically with a spousal RRSP, there was a 2-year clock that you couldn't pull the money out. This type of restriction doesn't exist for the TFSA. That was the 2 questions that we had. Obviously, if there's any other questions that people think about, feel free to reach out to Shane or I, and we'd be happy to chat further.
Absolutely. Very topical presentation today. Yeah.
Thanks for attending. We really appreciate it.